From Gen Wealth Financial Advisors, it's the fastest 4 minutes in investing.
Well, talking about the markets, and more specifically today, John, we're going to focus in on interest rates. And if you look at where the markets have been in the last week or so, we had a tech sell-off. We had a little bit of a rotation to what we are calling, I guess, the reopening stocks, right? The recovery rally. But still, in 2021, the general consensus is that equities are going to have a good year. The bull market is on. The one headwind, though, is interest rates. The interest rates are ticking up. We're seeing that, and it's increased volatility when it comes to trading the bond market. Yeah, the bond market has not been off to a great start in 2021. If you look at the 10-year Treasury yield, it started the year at 0.91, less than 1%, and ended the month of February at 1.41%. Now, you might think, well, that's not a big move, but that is a pretty big move as far as interest rates are concerned. And it's down, actually, from the intraday high of 1.61%. So fixed income assets are off to one of their worst starts that we can ever remember. Now, does that mean you need to bail on the bond market? Absolutely not. A well-diversified portfolio needs bonds because we know, yes, we think that the equity market's going to do well, but there's also some volatility in that equity market, and you need the bond market as a buffer against that to some degree in your well-diversified portfolio. LPL Research is always looking at this and giving us some projections, and they are to some level predictions. They don't know for sure, but they did change their guidance or had a relook at their guidance for their year-end forecast for the 10-year Treasury yield. It was 1.25% to 1.75%, and I said change. That's incorrect. They're holding to that. They still think 1.75% is a realistic high-end range by the end of the year. So if you compare that to where it ended February, that again, is a move. It doesn't look like a big move, but it is going to be a big difference by the end of the year if that forecast is right.
Yeah, and that is not all bad news. Yes, the value of bonds that were bought when the market was so low are going to erode in value as those interest rates come up. But what also is happening here is you're actually getting a little bit better yield on those bonds. And frankly, Scott, when you buy a bond, you've got to think about it as almost a cash cow. It is going to produce that milk, if you will, that cash out to you. And if rates are higher, that means that you're actually getting a little bit of interest that you really weren't getting beforehand. So we think that bonds are still a good place to be as far as a diversifier is concerned, but you're going to have to get your return from the equities. And I think that you also have to begin to be a little bit more long-term in your expectations, where people have kind of gotten used to really good equity markets and bull markets and things of that nature in their portfolios. I think that that's going to elongate a little bit now, and we're going to see it take a little bit more time to get the kind of returns that you're looking for. But patience in this case is a virtue.
I think with our last minute here, I think it would be important too to talk about in the context of our planning for our clients and the way we do retirement income planning. The value of bonds is really the absence of the volatility or the lower volatility compared to what you'll see in the equity market, because you're going to be using that money in the near term.
Yeah, absolutely. If you think about someone who's accumulating money, bonds are probably not a great import as a big part of your portfolio. But if you're retired, you need that stability of fixed income to be able to give you the ability to withdraw money out without having to, as I like to say, sell into the wind. You don't want to sell when the market is going down, and the bond portfolio actually gives you that buffer to be able to do that.
So for us, it's a little bit less about asset allocation and more about the designation of time segmented money, the bucket of money that you're using, and being able to take away some volatility there. That's a look at the fastest 4 minutes in investing. We'll continue on the Get Ready for the Future show next.